Positive cash flow. Well, if you're a real estate investor and it all comes together for you, this is what you're rewarded with at the end of every month. A property that not only provides a second income stream, but simultaneously increases your net worth month in and month out. In our video today, we're going to look at all of the variables that need to be considered by real estate investors to achieve positive net income. We're going to look at ways you can maximize your rents and minimize your expenses in order to achieve the highest possible net income month in and month out. We're going to look at a real world Calgary case study where we'll open up the spreadsheets and I'll share with you my approach when I'm evaluating a real estate deal to see, will it achieve positive cash flow or won't it? Are you ready to get down and dirty and explore positive cash flow in a bit more detail? All right, let's dive in. All right, well, the easiest way to conceptualize positive cash flow is to think of each one of your income properties as its own independent business, where it's got to turn out a profit for you as the business owner each and every month. That means you've got to maximize your top line revenue and minimize your expenses each month so that the bottom line, the net income, is as strong as possible for each individual property. So in order to do this, it's an exercise of optimization for each one of the variables within the equation. How can you get the best rents? How can you minimize your vacancy loss? How can you minimize your repairs or maintenance or utilities expenses? These are the things that real estate investors have to think about and have to be on top of each and every month in order to generate the highest possible net income out of each of their properties. So I think the easiest way to show you guys how to achieve this would be to walk you through an actual Calgary case study where we will look at a real world example of an income property purchased by one of our clients and take you through step by step how to maximize the rental income and minimize the operating expenses in order to achieve the highest possible cash flow. And then along the way, we'll also share a few tips and tricks that we've learned throughout our years of managing income property. All right, so let's dive into the spreadsheets and take a closer look at this. Okay, well, here we are ready to talk about net income, positive cash flow, and what can we do as real estate investors to maximize the positive cash flow from our investment property. So I am back in here with my trusty investment property deal analyzer spreadsheet. This is a tool that I've used for over a decade here to help me skin any deal in real estate. I can find out whether or not a property will make money or lose money in a few short minutes by using this spreadsheet tool that I've made, which any of our clients, we're happy to run numbers for you on any deal that you're looking at. So before I go and dive into how we can maximize cash flow and get into the numbers here on this, why don't I show you the case study that we're actually looking at here and the property that forms the basis of our analysis. So this is a bungalow in a community called Cedar Brae. Why don't I show you where it's located? It's over here. Our client purchased this not only for its present day positive cash flow, but because it's also located in an area where lots of stuff is happening. So the Sutina Trail here, the ring road, the Southwest Calgary ring road, this is brand new and has just come in here this year in 2020. And then in addition to the ring road, the Sutina First Nation, you can't see it on Google Earth here yet, but they have got an enormous development here called the Taza development, $4.5 billion going into this area here, and it's going to have all kinds of employment stuff. There's already a Costco in here right now, so lots of retail, lots of commercial, lots of recreation, and leisure and amenities are going to go into this development. I can't wait to see it built out here. So our client bought in this location not only to make money now, but because she knew that the wave of appreciation and the wave of further rental demand is definitely coming to this particular area. So this is the location that it's in, and this is what it looks like. It's just a standard bungalow built in the late 70s or early 80s. You can find these all over the place in these areas. And so the investor that purchased this property, she bought it to fix up the upper level, which you can see here just needs a little bit of work. And so these are some of the things that will play into positive cash flow. Is you want property that not only looks appealing, but isn't going to need a lot of repairs and maintenance work. So doing things like changing out old dingy carpet and putting in perhaps a vinyl plank flooring system or even hardwood flooring that's going to not only look better but last longer can have a positive effect on your net income each and every month. So here's what the property looks like, and yes, that is a washing machine right inside the kitchen here. And the reason it's there is that this property is separated into two different suites. There's a suite on the upper level and a suite on the lower level, and so that is also playing into the cash flow equation for this particular property, because our investor wanted to take the illegal suite that's in the basement here, which you can see here in a moment. We'll just jump down to this. Here's the basement property, full of tenant stuff. This type of real estate isn't glamorous. We're not talking Martha Stewart living here. We are talking income property, and that means how do you get the most amount of cash flow for the least amount of investments, and that means buying illegal suites and then fixing them up, making them into legal, safe properties for tenants to live in. So not only are our investor clients helping to increase affordable housing in Calgary, but they're also setting themselves up for financial freedom at the same time. So this is the property that we were looking at, a secondary suite, legal secondary suite conversion located in Cedar Brae. So let's get into the numbers again here now so we can see it. So this particular deal purchased for $375,000. It then needed renovations in the amount of $25,000 to legalize the existing illegal basement suite, and then also freshen up the upper level to make it look a little bit better. When you add in the closing costs in here, the overall project costs, you're into this for about $400,000, very affordable in Calgary. You're looking at a down payment ratio of 20% down on that, plus the renovation capital that's here means your overall capital coming into the deal is approximately $101,000. So for this particular deal, we are looking at the acquisition price of the property and the renovations amount over and above that. We are not looking at the post-renovated value and then building our financing out from that one. So for this deal, it's 20% down on the $375,000, and then you're also having to come up with this $25,000 in cash. So you're actually a little bit better than 20% loan to value, because you've increased the value by the amount of the renovations, at least, probably more than that in this instance. But we're just going to talk about cash flow here today. So for this one, we're looking at a loan, a base case here of $300,000. I'm going to adjust the amortization length on this before we look at the cash flow to 30 years. So our mortgage amount here is $300,000. Our interest rate is 2.35% amortized over 30 years for a monthly mortgage payment of $1,100 per month. Are looking at our income on this, with the upper suite income, utilities included, is going to be $1,515 per month, and our lower suite rental is $1,200 per month, utilities included. So when you're legalizing a basement suite in Calgary, very seldom will you separate the utilities so that the upper tenant pays their own and the lower tenant pays their own. You just don't get any extra revenue for that, and so we don't typically recommend it. The way that we manage the utilities is after a year or so, our client will have a really good idea of what the utilities expense will be for that property. We're estimating it is $425 per month for this particular deal. And that's averaged out over the 12 months of the year, so less in the summer and more in the winter. But what we do is we look at generally the number of bedrooms on the upper and the lower and do a ratio based on that, or you can do a ratio based on the number of adults that are living in your property any given time. But usually it's 2/3 up, 1/3 for the lower, or 3/5 for the upper, 2/5 for the lower, something like that. And then what we do is we look at the average utilities amount and then just assign a utility surcharge to each of the two tenancies to basically create a utilities included arrangement. That can also have positive impacts on the investor client's ability to get approved for their subsequent investment property purchases, because they get to show a higher gross rent number, and some lenders aren't fussed over the utilities being included in that amount or not. Each lender is just a little bit different with that. So it never hurts to bump up your gross income numbers on mortgage applications, and so that's why we prefer this utilities included arrangement. All right, so our gross rents on this is $2,750 per month. Looking at our operating expenses now, I've included property management in this deal, which is factored in here at our property management company's 8% rate. That's our multifamily rate that we charge to manage property here in Calgary. But I like to have a rate in there for this so that the investor knows that if they did want to hand it over to a professional property management company so they didn't have to deal with rent collections and tenants and accounting and repairs and maintenance calls and all that, then they don't have to. And it's a factor into the deal so they know that they can make it. But if you're going to manage it on your own, you can obviously see the impact here. So skipping down to the bottom, you can see the way our deal is structured. This place will cash flow $400 per month. But if you took out the property management, now you're up $600 per month, which is pretty darn great. So usually I like to recommend for investors that are new to investment property real estate that you manage your properties yourselves for a couple of years until you get up to maybe half a dozen doors or so. And that will just give you such a great experience base for when you do transition to licensed property management or bringing in additional support to your business to help in the property management space, because you will have done it yourself and you know what tenants do and what they don't do, and it will give you a lot of experience to hopefully help you have a nice long career when it comes to investment property and staying in the income property game. So I've included management in here. Property tax kind of is what it is. This is right off of what this property would have paid for property tax last year. Insurance, this is a number that's based on our sort of experience factor and an insurance product that we would recommend for this. So we've got $115 per month in for that. You're going to want the right type of insurance for an income property. It's different than a homeowner's insurance policy, because if something happens and there's a claim, you want to know that you're going to receive the monthly income every month that you would get if your tenants have to move out. And let's say the worst happens, there's a big flood, your tenants have to be put up in a different rental property. You want the money coming in from your insurance policy to offset any money that you would have to spend to a tenant to live someplace else while your property is being fixed up. So get the right insurance policy for that, and that's a subject for a different video. Looking at vacancy right here. So vacancy is always listed as a cost on your operating expense, even though you might not incur it if you've got performing leases. But when you're looking at a pro forma, you always want to include the prevailing vacancy rate for the city that you're investing in inside your numbers. So in Calgary, at the end of the 2019 civic census, that number was 4%. So that's what goes into our pro forma here, 4% of the total gross rents that would be received from it. Our utilities amount is based on experience for that particular property, but a way to get this is just when you're buying a deal, within your conditions, just ask the listing realtor to have their client, the seller, get some 12 months worth of utility statements together for you to look at, so that you can average it out and then stick that number into your analysis to make sure that it's not a bad property, a leaky property that's going to be expensive to provide heat to, and then also to give you a pretty good idea of how much you should set the utility surcharge amount for your first set of tenants. So that's how you'd go about that. Repairs and maintenance, we've set this at 4% for this particular deal, which is probably a little bit low for a 1970s house. And the reason we've got it set at that amount is, if you remember, we're doing some renovations and some upgrades to this property. So when you go to buy something, an investment property, you're going to have a property inspection performed. It's going to tell you all of the things that are wrong with the property and that you should either fix immediately, or that you could ask the seller to reduce the price so that you can have additional budget room to fix it now, or things that you need to be mindful to fix over time. So generally speaking, when I buy property, I like to get them fixed up and ready to rock and roll for that first 5-year period without requiring any major repairs or maintenance items that are left unaddressed. So when I'm renovating my property, I choose to get ahead of my repairs and maintenance through a capital investment upfront, rather than deal with the risk of it showing up later, because it sucks to have a large repair bill happen in the middle of an otherwise well-performing tenancy. Then you risk losing your tenants and having significant negative cash flow. I always find that to be a more stressful element to manage than having a larger project at the front end. Repairs and maintenance is lower for this because it contemplates many things being fixed up at the beginning of the investor's ownership of this property. So it's set here at 4% for that, giving us a total OPEX of just under $1,200 per month, a net operating income here, $1,550, capitalization rate of 4.6%, and this cash flow on cash return of 4.7%. So many investors might look at this deal and say, $394 a month, I'm never going to get rich off of that. and you're not going to get rich off of your cash flow, but you will set up an income stream. And if you imagine having a few of these properties, maybe 5 to 10 of these types of things, you can have a dramatic increase in your net worth if you do it the right way and get all of these things going for you. But you're investing about 101 grand here to get approximately $394 a month out of it. So your cash flow on cash return would be the amount of cash flow that you're getting here, just under $400 per month, times 12 months, and then divided by the total amount of capital that you have to put into the deal, which gives you this rate, this cash flow on cash return rate of 4.7%. Now, I'm just going to take a quick minute here to drop out of something and show you guys something else, and that is a presentation that I made a couple months ago about income and how challenging it is to find. So these are just a few slides from this where I went over how challenging it can be to find positive cash flow in any type of investment or anything. So most of us do it by converting our time into money by working at a job, and the whole idea is, okay, well, you work long enough and hard enough, you're going to get enough money out there, and supposedly you can take that money and turn it into an income stream for you. And many investors would look at real estate as a way to do that, and it is a great way to do that. But I wanted to quickly contrast real estate versus stocks just for a minute here. So back at the end of 2019, Money Sense magazine put out an article here about the best dividend stocks in Canada that were available, and they go and they have this chart here and they say, here's our top ones, and they have this concept of a dividend yield. So a dividend yield would be the percentage of dividends that are issued from that particular stock relative to the stock price. And so you can see here, these are the best ones. Many of them are banks, also real estate related, because these loans are secured by real estate. You can see that here, lots of them. So the dividend yields on these are, the best one is 5.1%, but you can see here we're in the low single digits, 2.6 up to 5% in that type of range for dividend yield. So if you were trying to get income out of investing in stocks, it's not an easy thing to do. And so if you come back over to our real estate deal here, our little tiny bungalow in a small suburb in Calgary, we're able to get a cash flow on cash return, which is the real estate equivalent of a dividend yield of 4.7% for this particular deal. And we've got some nice safe assumptions built into all of this. So our nice little bungalow here in Calgary, all things considered, still does pretty darn well compared to some pretty A-list stocks and the best of the best that Money Sense magazine was able to recommend at the end of last year. So even though the cash flow numbers aren't going to blow you away, they're still very, very healthy in the context of being able to generate income from any sort of investment that's out there. So that's how we can do it here. How can you maximize your net income? Well, it's pretty straightforward. You're looking at increasing your rental amount and decreasing your operating expenses. So things like improving the look and feel of your property, making changes in appliances, changes in flooring, making them look a little bit nicer to increase your rental amounts. And then in terms of reducing your operating expenses, well, it's getting the right type of insurance and not being overinsured. Keeping your vacancy rate down, which is often the same things that you would do to maximize your rental income, you can reduce your vacancy risk. So investing capital up front, this renovation capital, to improve the look and feel of the property, such a great idea because you get a double duty return on it, not only through greater rents, but a greater likelihood that you maintain high occupancy or a low vacancy rate here. Utilities, so asking your tenants and watching the bills closely, investing in energy efficient appliances, making sure you've got the right insulation and that you've plugged all the holes when you're looking at a deal from an acquisition perspective. That matters there too. And then making sure your tenants aren't over consuming utilities and doing inspections to make sure that they're not leaving lights on, leaving the heat too high, that type of thing. And then your repairs and maintenance, this comes back to, again, making sure you've put the right amount of money in at the front end so that you don't have ongoing expenses that are going to hammer your net income down every month. And then making sure that your tenants know that they can't be doing damage to the property, so you've got good move-in reports, good leasing information on that to keep that low. And so if you do all of that the right way, and you can get this nice strong number out of cash flow for it,
You can generate that additional income stream for you. And so at the same time as you're building your net worth here by paying off all of your principal and hopefully getting a little bit of appreciation, you also have this positive cash flow income stream out of it. And it is possible to do that here in Calgary now. We've got great rent to price ratios and lots of great investment property opportunities with the way our market has been behaving lately. And so you can do it. And yeah, so that is basically net income explained and how to optimize it and some tips and tricks behind it.
All right, well, as you can see, there's an awful lot of math going on behind the scenes in order for real estate investors to achieve positive cash flow. Successful real estate investing means you got to juggle a lot of different variables within the cash flow equation and be able to maximize your rents and reduce your operating expenses as much as possible. Now, if you're new to real estate investing, let me tell you, it can seem daunting at first. It can all seem overwhelming, this concept of learning all of these new things and being expected to put them all together to achieve positive cash flow at the end of every month. Well, I can tell you, just like anything else in life, it gets easier and easier the more that you do it. So if you're curious about this, stay engaged within the field, get network, talk to other real estate investors, talk to pros within the industry, skin some deals, look at some property, and the more that you do it, the less intimidating it will be, and the easier it will be for you as an investor to see opportunity within properties, ways that you can maximize income and reduce the expenses in order to achieve positive cash flow. And at the end of the day, the reward is tremendous. You can create a completely separate income stream from appreciating assets that not only provide income, but will also increase your net worth over time. And to go to bed at night knowing that you've done this for you and your family is just such a rewarding experience, and is something that any entrepreneur should be looking at as you contemplate how are you going to level yourself up in life and in business. Look, I hope you've enjoyed the video today. I've certainly enjoyed making it for you. Thanks very much for watching. I hope it was informative, and happy investing.